Thank you everyone for being here today and welcome for our webinar for today. We're very excited to share our insights and happy for all the interest on this topic. Our topic for today will be the 2021 transfer pricing documentation requirements in Malaysia. I know you're all eager to get started, but before we dive into the topic, allow me to introduce our firm. I see some familiar names in the audience, and for those who are already our clients, welcome and great to see you again. So we are a boutique firm that specializes in transfer pricing consulting services. Our firm attracts the best talent from the leading accountant firms in transfer pricing. We love to recruit individuals who are passionate about transfer pricing and helping business with the transfer pricing risk. We have all 3 offices, our head office in Australia, where we started our business 13 years ago to cater the Australian and New Zealand business, our office in Singapore and Malaysia that caters our Asia and Malaysian multinational clients. We're also very proud to have been recognized with several awards. A couple of them will be the best account transfer pricing firm of the year in Australia and Asia and best newcomer. We also contribute.
Adriana, sorry, I got to stop you there right there. I think you are showing the actual slide itself and not in presentation mode. So I think you're still at the second slide.
Okay.
Let me see whether.
Let me just reshare again.
Yeah.
No problem. There you go.
Cool.
Yep.
Yeah.
Now? Okay, excellent. So coming back to our slides, we also contribute regularly to industry journals, including the Institute Singapore Accredited Tax Professionals Journal, and also several industry journals such as M&E Tax. And with that, I would like to present our panel for today. Our first presenter will be Hon Chuan Tan, who is the co-founder of Transfer Pricing Solutions Malaysia. He is a brilliant technical mind who prides himself to go the extra mile for his clients. He has set up a transfer pricing practice for one of the leading accountant firms in Malaysia prior joining Transfer Pricing Solutions Malaysia. And our second presenter for today is Kevin Tai, who is our head of global operations and senior manager. He has over 9 years of experience advising multinational companies with transfer pricing issues across Australia, Asia, and the US. He also prides himself to always be updated with all the latest transfer pricing developments. And he also has wide experience in helping clients with transfer pricing disputes across Australia, Asia, and Malaysia. And I will be the moderator for today. Let me just, I think I'm having a delay in the slide. Sorry about that. There you go. So my name is Adriana Calderon. I'm the co-founder of Transfer Pricing Solutions Asia and Malaysia, with more than 15 years of experience in international tax and transfer pricing across 4 different countries and a wide range of industries and business models. And with that, I will be more than happy to pass the baton to Hon Chuan Tan, who is our first presenter for today.
Thanks, Adriana. Thank you guys for joining us in this very exciting times, or not so exciting times for taxpayers, unfortunately. As you are aware, the COVID crisis has impacted the economic situation globally, including Malaysia, whereby economic stimulus packages are provided to help individuals and companies transition through the economic retraction. With this in mind, the government would need to obtain funding from different channels. And definitely one of the channels will be from transfer pricing, right? The recent changes have shown that the Malaysian Tax Authority will be very aggressive in conducting transfer pricing audits on all fronts. And based on my experience, TP is actually a very low-hanging fruit for tax authorities to obtain income from. right? The Malaysian Finance Bill 2020 was released on 6th of November 2020, which incorporates rather significant transfer pricing changes to the Income Tax Act. The changes provided greater authority to the Malaysian Tax Authority and re-emphasizes on the importance of TP compliance going forward. Right. Next, we're going to go through the key amendments made for this webinar. Right. The four key TP amendments are the penalty for failure to finish TP documentation, surcharge for TP adjustments, TP documentation to be made available within 14 days upon request, and finally, tax authority to disregard structures in a controlled transactions. Right. Next, we're going to go through the penalty and timing together.
But before that, Hon Chuan Tan, let us release our first poll for today. So if everyone in the audience could participate in our first poll this afternoon. We will give it about 2 minutes for recording or for everyone to answer.
Yes, cool.
So it will be great. Excellent. Very quick votes coming along. We have 40%.
Be interesting to see.
While we do the poll, I would like to remind the audience that we have the Q&A function where all the attendees can pose their questions, and we will be reviewing them and answer them during the Q&A at the end of the webinar. So we have 1 minute, 70% voted. Well, 10 seconds. Okay, I will end the polling now and release the results.
All right, let's see.
Can you see the results? Yeah.
Yes.
Okay, so we have that 39% don't have transfer pricing documentation in place, 27% yes, and is contemporaneous, 16% yes, but prepared a few years ago, and 20% I don't know. So we hope that we can resolve some of the questions for those of you who answer no, I don't know, or prepare a few years ago. For those of you who answer yes, it's contemporaneous, we hope we can give you a couple of key tips to manage your transfer pricing risk going forward. So with that, I pass it to you, Hong Chuan Tan, to continue.
Thanks, Adriana. That's actually very interesting results from the poll. Okay, let's talk about the penalty and timing. All right. Prior, if you look at the slides, the next slide, prior to 1st Jan 2021, there was no specific provisions imposing a penalty for a failure or late submission of TP documentation. Right. Under the new Section 113B, failure to finish contemporaneous TP documentation will result in a penalty of ranging from 20,000 to 100,000 ringgit, or if upon conviction, I'm looking at you directors there, penalties of 20,000 to 100,000, or imprisonment for a term not exceeding 6 months, or both. Right. This is actually a rather significant change to be introduced for the failure to finish TP documentation. Right. Next, we're going to look through the penalties under the TP audit framework before the introduction of the new provision. So under the previous TP audit framework, as far as I know, the TP audit framework has yet to be updated to reflect the new timing and the additional penalty involved. The current TP audit framework states that where taxpayer did not prepare a TP documentation, there's a penalty rate of 50% of the additional tax payable during an audit case. Right, this is where you did not prepare, not fail to furnish. Then the second one would be where TB documentation is prepared, but not in accordance with the TB guidelines, or if you have comprehensive TB documentation in place, but not submitted within 30 days, your penalty rate is 30% for audit case and 20% for voluntary disclosure case. And lastly, where the TP documentation is comprehensive and submitted within 30 days, the penalty rate will be 0%. But in my years of experience, I've yet to see this scenario happening. When the tax authority makes a move, you can be sure that they want something in return. So be aware. Next, we're going to go through the timing to finish the TB documentation. This is actually a rather interesting one, where the timing itself was actually not disclosed in the Finance Bill when it was actually released. And it was actually disclosed in the LHDN transfer pricing website under the transfer pricing guidelines changes, right? You can see there that they've made changes to the timing itself. Prior to 1st Jan 2021, TP documentation needs to be submitted within 30 days upon request. Effective 1st Jan 2021, for audit cases that have commenced before 1st Jan 2021, the timing stays the same. And for TP audit cases commenced on or after 1st Jan 2021, the TP documentation needs to be submitted within 14 days upon request. Obviously, now that we are in the second quarter of 2021, I would imagine we will need to comply with that 14 days ruling. Now, I've been asked quite a few times on whether this applies retrospectively on audit cases for the previous YA year assessment. But the key point here is the timing of the TB audit cases rather than the year of assessment. So which means if you have been targeted for a TB audit now, right, you need to finish your TB documentation within 14 days, regardless of the year assessment from the audit case itself. So please be mindful that now, regardless, you have 14 days upon request to submit the TB documentation. Thanks, Adriana.
No problem. And with that, let's continue with surcharge and the new powers of reconstruction. And I will invite Kevin Tai for that segment.
Thanks, Adriana. Hong Chuan. Hi, everyone. I'm Kevin. So now, as we have known, in addition to the penalty for late or failure to lodge or submit transfer pricing documentation, the bill also introduces a surcharge on transfer pricing adjustments. Now, before we go into details on what the surcharge is, let's have a look at how penalty on transfer pricing adjustment works prior to this bill. Okay, so prior to 1st of January 2021, when the IRB makes a TP adjustment on taxpayers' transfer pricing arrangements, it changes the tax position of the taxpayer. This usually means that there will be a shortfall in tax payable. Now, when IRB will then apply a penalty on the shortfall amount. However, before 1st of January 2021 or before this bill, the penalty can only be applied under very limited circumstances. One being you have to be in a taxable position. That is, you are not making losses during the year, or you do not have carry forward losses to offset all your income for the year. Now, what happened when this bill comes in effective 1st January 2021? The IRB will impose or can impose a surcharge of up to 5% on all TB adjustment made to the taxpayer. Now, different from last time, this adjustment does not have to. This adjustment can be applied to taxpayers regardless of whether or not they are in loss-making position. So, in other words, following this bill, as long as you get a TP adjustment, you will be expecting to see this surcharge coming on together. Okay. Now, that is the surcharge part. In addition to that, the final part of the TP amendments from this bill looks at what we call in the transfer pricing the reconstruction provision. Now, under this bill, it proposed to include what was the Rule 8 of transfer pricing rules, the Malaysian transfer pricing rule, to the Income Tax Act. Now, this effectively gives the Director General power to recharacterize any transfer pricing structure under two conditions. Condition one, if you have your economic substance that is different from your form, meaning if your transfer pricing arrangement, what is actually happening in your company, is not consistent with your what it says in your intercompany contracts or what was described in your transfer pricing documentation, that is condition one. And then condition two, the arrangement, the transfer pricing arrangement that you have in place lack commercial rationale, or it simply doesn't make commercial sense to get into that type of arrangements. Now, when this bill get implemented and this reconstruction provision got officially included in the Income Tax Act, we will expect the IRB to put more emphasis on commerciality and substance of your transfer pricing arrangement in the future, in any future transfer pricing review or audit cases. So this you have to bear in mind on this particular aspect when you are preparing a transfer pricing study. Okay, now that we have gone through the 4 key TP amendments, we have prepared a case study to show you how this impacts your new your transfer pricing arrangement moving forward, and how would a new penalty applies to you. So in the case study, if you go next, Adriana, please.
Yeah.
So in the case study, let's say, for example, we have a parent company based in Thailand, which enters into some transfer pricing arrangements with its subsidiaries in Malaysia. Now, the Malaysian entity has been experiencing tough market condition, especially during this COVID time. And over the years, he has been accumulated tax losses. And because of this financial position they are in, they have decided not to invest in the transfer pricing documentation for the transfer pricing arrangement they have with the Thai head office. Now, earlier this year, the IRB conducted a transfer pricing audit on the Malaysian subsidiary. During the audit, as in any audit, the IRB asked for a copy of transfer pricing documentation to be provided to them within 14 days. Now, as the company do not have transfer pricing documentation, and given the timeline is so short now for 14 days, they are unable to provide IRB with the transfer pricing documentation. Now, then it moved on to audit. After a series of reviews and analysis, the IRB concluded that the Malaysian subsidiary has been engaged in some non-arm's length dealing with its parent company, and as a result, a transfer price adjustment of 3 million ringgit were made. Okay, so how, under these circumstances, what can happen to the Malaysian subsidiary? Firstly, we look at the penalty. Because the Malaysian subsidiary fails to provide transfer pricing documentation to the IRB within 14 days, it may be subject to up to 100,000 ringgit fine in penalty, right? On top of that, the director of the company may be subject to up to 6 months imprisonment sentence. Okay. Second, a TP adjustment has been made, a 3 million TP adjustment has been made. Now, this can trigger a penalty of up to 50% because you don't have a transfer pricing documentation. And because the audit was conducted this year, meaning post 1 January 2021, it also attracts a surcharge. Now, to put this in value, the surcharge will work out to be approximately 150,000 ringgit. That is just for the surcharge. And then on top of that, you have your TP adjustment and you have your penalty. But what if this audit was done last year? So keeping all the facts and circumstances constant, a TP adjustment will still be made, but the Malaysian subsidiary would not be subject to any penalty as it is in losses. And naturally, there won't be a surcharge as well. So if you look at the comparison, because of the huge economic impact the penalty brings to the taxpayer, we have been telling our clients to, take these changes seriously. At the very least, ensure that you have proper transfer pricing study in place and documents to support that at least the key and material transfer pricing arrangement you have in the company.
Thank you.
Yep.
Thank you, Kevin. That
Yep.
has been quite a eye opener in terms of the dollar value of that has the new changes and the implication for multinational groups. With that, I will pass the baton now to Hon Chun Tan, who will be discussing the effects on small and medium-sized enterprises. You have to unmute yourself.
Yep, sorry.
Yeah.
Thank you, Adriana, and thanks, Kevin, for actually showcasing the impact of the new rulings. Right, if you look at the new rulings, it actually impacts both SMEs and MNEs. Right, they are getting more clever in getting their penalties. Right, so the fixed penalty of 20 to 100,000, that would affect the SMEs, while the surcharges, though if you look at the percentage, SMEs will think that, oh, that's a small change, small value, but for MNEs wise, that is actually a huge value when you're looking at millions of tax adjustments. So keep that in mind. And with the introduction of the new penalties, one thing that came to mind is SMEs will be greatly affected by this change. In 2019, SMEs contributed about 38.9% to Malaysia's GDP. And interesting fact is it makes up to 98.5% of total registered businesses. So this in itself is actually a huge pool of income for tax authorities. So their eyes are blinking. Transfer pricing awareness in Malaysia has been increasing since the introduction of the Malaysian TP Guidelines 2012, coupled with the introduction of the TP declaration in the corporate tax return in 2014. That's where transfer pricing in Malaysia started booming. The awareness itself has increased. The previous ruling has affected the MNEs to comply with the TP rules. Well, now that's done and dusted. The Malaysian Tax Authority may be coming after the SMEs now with the new provisions. The lack of clear penalties, as well as the ease of burden under the Malaysian TP Guidelines 2012, allowed the SMEs to go under the radar, as SMEs deemed the transfer pricing compliance was not necessary. That was based on my experience with my previous clients regarding the preparation of TP documentation. With the introduction of the fixed penalties as well as shortened timeline to furnish the TP documentation upon request, SMEs that have not prepared any TP documentation, I'm looking at the 27% earlier, are effectively caught under this regime, which will force the SMEs to be compliant. While we understand that it's going to be a struggle as SMEs are also greatly affected by the pandemic crisis, unfortunately, as compared to the MNEs, SMEs had it affected pretty hard. With lack of resources, it's going to be tough to actually balance the cost of compliance and also your ongoing business operations. You want to be profitable in 2021 going forward. So generally what we advise clients is to actually comply with the bare minimum of the TP requirements, at least to have that penalty protection in place instead of leaving it too far behind, which is what we are experiencing now. So next, I'm actually going to talk about the common misconception that we generally face when I was asked questions by the potential clients. So next slide, we talk about the top 3 that I've currently faced. I've been told that simplified TP documentation only needs to disclose paragraph 11.2.4 subsection A, C, and D of the Malaysian TP guidelines, and the TP report stops there. But actually, that's not the case. ACD are organizational structure, control transaction details, and pricing policies of your group, right? We call these statement of facts that provide a story of the group and its related party transactions. Now that's fine, but the option is there to relieve the smaller taxpayers' burden to disclose more than necessary as compared to the full-fledged TP documentation. But it does not mean that it stops there. The taxpayer is still obliged to actually test the arm's length nature of their related party transactions. So that's the key fact of the TP report. Point number 2, similarly, simplified TP documentation does not need to go through the selection of TP method process, right? But taxpayers will still need to apply the appropriate method to test. Depending on the circumstances, taxpayer may still be required to perform a benchmarking search in order to test the arm's length nature of your controlled transaction. And lastly, this one of the ones that I've been asked a lot, whether 14 days is actually sufficient to prepare a simplified TP documentation. Well, to be honest, 14 days is generally not sufficient to prepare, as it still requires proper analysis to test the real party transactions. Now, in emergency circumstances, we may still be able to prepare within 14 days, but that would put a lot of stress to your company and resources, as a lot of information will need to be requested and analysis are needed to be done within that time frame. So, and the general timeline would be 4 to 6 weeks to prepare, depending on circumstances. So we generally advise taxpayers to actually start now instead of waiting it for too long before the IRB comes, because 14 days will generally not be sufficient.
Okay, and before we move on into the key takeaways, let me just release our second poll for the audience. Okay, so it would be great if everyone can participate. So our second poll will be, what is the management stance on your group's transfer pricing compliance? And the options are prepare yourself, outsource, wait and see. %56%. One minute. 62%. Just give it a few more minutes. Okay, let's see the results. We have 74%. Now we're reaching almost 2 minutes. So maybe we will give 10 seconds more to end the polling. Okay. So let me share the results. Okay, so we have a big spread between prepare yourself and outsource, being about 43% prepare yourself, outsource 50%. And I think we are pleasantly to read that wait and see is 21%. So for those who answered wait and see, keep in mind this 14 days rule. That might be a bit of a struggle to put together contemporaneous documentation only when it's requested. And with that, we will move on to the key takeaways, and then we will open the floor for questions.
All right. Let's hope that wait and see people reduce it to 0% going forward, because that penalty will be quite hefty. As you can see, from the impact of the amendments, taxpayers should familiarize themselves with the term contemporaneous, which means to have the TP documentation prepared by the tax filing due date, right? This is a rather new term for taxpayers, because generally they prepare it after tax filing due date, or generally they prepare it when IRB comes in. So it'd be good to have that TP documentation prepared by the tax filing due date, so you're ready and you won't be imposed by the penalty. Secondly, to be prudent, TP documentation should be prepared for all open years, which is 7 years. Now, we advise clients to at least get the latest year done, and then we can move backwards. So at least this way, the initial hard work is done for the latest year, and we only need to worry about the analysis for the previous year. So the statement of facts should rather say it's the same, or rather there will be minimal changes within that 7 years. So the analysis is the important part that you can then focus on later on. Next, we need to ensure that the control transaction reflect commercial reality, which means the control transaction should have commercial reasons as to why it has been performed. And then taxpayers need to let go the thought that you are safe if you have tax incentives, unutilized allowances, or business losses, because now with the new ruling, you'll be caught under that penalty surcharge. And lastly, 14 days is realistically not sufficient to prepare.
Sorry, I'm going to go back. I moved too quick, so just here.
Nope, that's fine.
In the last point, no problem.
Yeah. Lastly, the 14 days is realistically not sufficient to prepare the TP documentation for the initial phase. At least get the TP documentation base done, so that you won't have to rush out to get that TP documentation when IRB come and knocks on your door. Because based on my experience, sometimes when they come, it is unexpected. I've had experience where they raided our clients' offices without any notice. That's very rare, but it happens. So they raided, and luckily we have that TP documentation in place beforehand. The only thing is we need to make sure that everything is done properly, and so that everything reflects what we have documented. So having that TP documentation prepared in place, right? Not just having the report itself, also getting you ready during the TP audit wise, because during the preparation, you understand the flow of the TP report. You understand what's been reported in the TP report. You know what's going on, because when we work with you, you know what is required for the TP analysis. And then from there, the head of entities, the head of departments will then realize what is required when the IRB were to come in, and when they question you, the head of departments, the CEOs, CFOs will know what questions are actually going to be asked by IRB, and they're actually ready to answer, instead of being inconsistent with the TP report to be prepared and the response provided by the key personnel. So if there's inconsistencies between the TP report and the personnel itself, that would spell trouble, because IRB will then dig further as to why there's a discrepancies between the information provided. All right. Thanks, Adriana.
No problem. And I think one last point that is very important is to understand that transfer pricing doesn't have isolation consequence. Transfer pricing falls within tax, and that's why it's a niche area of international tax and tax. So what it happens is that multinational groups will have to be very mindful of what we call the domino effect, which means that incorrect transfer pricing can lead to prior year transfer pricing adjustments. We will lead to amendments in the tax return because there was an incorrect tax returns being filed. potentially an indirect tax issue on prior indirect tax returns, and a corresponding tax adjustment that could lead to double taxation. So that could lead to a lot of administrative burden internally for the company to correct prior year's tax returns, and also will lead to double taxation because the chances are that the corresponding country will not be able to do the corresponding adjustments unless they decide to go under an MIP, which is mutual agreement procedures, to resolve a double tax issue. Before we open to the floor for the Q&A, we will just in 1 minute summarize how can we help, and then I will open the floor for questions. There are already a few questions, and I also have a few ones that I would like to share with the audience. So with that, Juan Chantan.
Thanks, Adriana. Well, before we show the services that we provide, I just want to tell you what our value add is in our service, right? In accordance to our first name, we pride ourselves as the specialist in our field, not just in Malaysia, but in other regions as well. We have a global database to perform benchmarking searches, intercompany loans, and royalty or license fee search. Secondly, we maintain very close relationship with our clients, where our partners and directors are directly involved in the job from start to finish, regardless of size. I'm sure our current clients will know that. This actually provides assurance to our clients that they are actually being looked after for, and the directors themselves would know from in and out what's your business operations and what's the TP risks involved and how to rectify that risks. Thirdly, we provide cost-effective and practical solutions. So we work closely with our clients to come up with the best solutions to meet their budget while complying with the TP requirements. It's actually more so now the case where there are a lot of queries on clients where they want to prepare the simplified TP documentation, but then they may not have the budget, right? So we provide a minimalistic approach and cost-effective approach to make sure that at least they get that protection done, so that going forward they wouldn't have that issue. And lastly, we provide value-added advice on top of the TP services that we provide. Right, the TP compliance does not stop at the finalization of the TP report. Right, we do not finalize the TP report and then done and dusted, but we then further go through review regarding the TP risks and the solution to actually minimize that TP risk if we encounter any issues during the course of our work. And then so that at the end of the day, you're actually getting value not just on the TP compliance point of view, and also to actually understand what is at stake for your TP position in your company. What's leaking? What's the diagnostic, and what's the solution to be provided?
Excellent.
Right? Thanks, Adriana.
Thank you for that. So with that, I will open with 2 questions that are live, but I also would like to ask a couple of questions to our panelists today. And I hope that some of the attendees may also be thinking about this. So if I am a Malaysia subsidiary and the head office has been preparing transfer pricing documentation overseas and a benchmarking, usual question from the subsidiary is, can I use transfer pricing documentation prepared overseas for Malaysia purposes?
Yeah, well, maybe I'll take that question. Okay. So Malaysia, as you know, we are generally an outsourced country, also manufacturing and trade distribution as well. So basically our headquarters will not be in Malaysia. So in that point, a lot of times headquarters would have prepared TP documentation, and as well as benchmarking as well for that particular transaction. So in that circumstances, we can actually use the TP report prepared and then actually leverage information that we deem as relevant, so that then it itself actually reduces the cost to prepare the TP report. That's one of the ways that we discuss with you, whether you have TP report prepared, and if you have, and then we can leverage information from that TP report. That will save a lot of costs from Malaysian point of view, because we will not need to do double work. Since the work has been done for your headquarters, we only need to leverage information from there and then tailor-make that report to and localize it to Malaysian point of view. So that's what we do.
I think there is a point here also to say that Malaysia tax authorities is one of the very stringent tax authorities in terms of very fixated on local benchmarkings as opposed to regional benchmarking. So would that be one of the main reasons as to why you will have to localize the documentation in Malaysia?
Yes, unfortunately, the benchmarking itself for Malaysia, they very much prefer local benchmarking to be put in place. So sometimes, even if benchmarking were to be prepared on a group level, it may not be applicable for Malaysia, which means we'll need to localize the benchmarking itself to include Malaysian comparables. So
is it fair to say, Hon Chun Tan and Kevin Tai, that in your professional experience, have IRB ever accepted regional comparables in the disputes that you have come across?
Based on my experience, almost all of our work actually uses local benchmarking. We have yet to encounter any that uses regional at all.
I think that's a fair point. That has been also my professional experience, that you would struggle to support overseas comparables, especially for benchmarkings to test services or contract manufacturers.
Sorry to add
sorry,
to that. Yes, so to add to that, when we are talking about benchmarking approach, whether or not you use a regional or you use a local benchmarking, from a transfer pricing perspective, it's always better to use a local benchmarking in any situation, because that gives you the most comparable in terms of market condition. Now, because some countries or for example, some countries like let's say take Australia, for example, you do not have a lot of manufacturers there. So it might be a bit difficult to identify similar manufacturers in Australia. That's why sometimes you go with your regional approach. But because Malaysia, you have quite a good information source, which is your SSM, where you can get a lot of good public information to do this benchmarking search. So that is really not a big issue to stick with local benchmarking for Australian entities. So I think local comparables is always better, and when we are talking about transfer pricing studies.
I love that comment because it really addresses transfer pricing 101, and thank you for that, Kevin. That is transfer pricing 101, right? And I think that's a really valid technical point that you raised. So with that, I'm gonna open to the first question, which is related to benchmarking, actually. So I'm gonna answer live so you can all see it. For benchmarking, does IRB accept benchmarking to information printed out of the SSM, meaning Companies Commission of Malaysia, or IRB only accept benchmarking for certain databases such as SPIDA,
SPIDA, yeah. I think SPIDA is growing for database, and we specifically use Thomson Reuters. So in terms of does IRB accept benchmarking to information printed out from SSM, right? That's the main source that I get from IRB. So the financials we also print it out from SSM because one of the ways to actually search for comparables is actually to look at the related party transactions, whether that particular comparable companies are actually tainted, which means the main source would be for SSM, right? Even from SPIDA database, the financials are actually still from SSM, right? They use the SSM's data and actually upload it to SPIDA. So at the end of the day, SSM is the main source to obtain that financial information.
I want to add to that question the concept and getting excited about Kevin and his technical input about the fact that we have to come back to TP basics of reliability of data. And in theory, I haven't seen any tax authority saying that they have a preference for a particular database. If we come back to basics, it's all about reliable data and data that is available for tax authority also to be corroborated. Because if you have data that the IRB cannot corroborate, that's also an issue, and that's where it comes from the reliability point of view. So that's why probably as long as the information is reliable, then and can be corroborated, then that allows for using data from the Companies Commission of Malaysia. Kevin, do you want to add anything on that?
Yeah, and I guess a little bit of background on this. You know, ever since transfer pricing started in Malaysia, SSM was the source for benchmarking, for local benchmarking. So yes, SSM is always accepted by the IRB. Now, because we are now moving into the digital era, it comes with, you know, we have more access to databases. Data is now more reliable and really readily accessible. That's why now you can see the IRB starting to accept, you know, information from database or benchmarking from database. Now, before this is still with information printed out from SSM. I remember on my graduate time, we used to, you know, spend the whole day in SSM printing out reports, bringing back to the office mountains of files and going through one by one to do our benchmarking. So that is the history of the benchmarking in Malaysia. So yeah, I would see that this will continue to be accepted by the IRB going forward.
That shows how many years have you been practicing transfer pricing. Okay, so I'm gonna open the second question, which is basically, can I confirm the revenue of 10 million is for the group of companies, or I'm guessing that's what it means, or individual companies?
Okay, I'm not sure where the 10 billion revenue is from. What's that? The taste?
It sounds like Singapore.
Is it Singapore?
Yes, but it sounds like Singapore. But I guess let's assume whatever is the revenue in Malaysia.
Yep. Maybe I'll answer the Malaysia, then you can talk about the Singapore as well, since we are here. For Malaysia, the threshold is revenue of 25 million, and then of revenue, and then 15 million, 15 of related party transactions. And so this add up together, then you have to reach that threshold. So that's for individual companies, individual entities, not on a consolidated basis. If you have reached that threshold, then you will need to prepare a full-fledged TP documentation instead of a simplified one.
Okay, so the point there probably is that you still have to comply with the arm's length principle, even if it is below the threshold, and some level of simplified TP documentation will need to be prepared if you are below. The person is clarifying here that is Singapore. In Singapore, the value of the revenue is also accounted in the same way, not on a consolidated group or an individual taxpayer basis. Okay, so I will answer another question that we have. What is the level of comfort if a company chooses not to do benchmarking due to the cost factor, but only prepare limited TP doc? How would you advise a client in such a situation? Should
I go first again?
Yeah, feel free.
Okay, so this is very much related to our Malaysian situation right now, where a lot of companies, a lot of clients come to me and say, okay, this is my revenue. I'm applicable for a simplified TBA documentation, but I wouldn't want to do a benchmarking because the company doesn't have the budget to do so, right? I think there are this is on a case-by-case basis. First, we'll need to look at your company situation in terms of financial, as well as the transfer pricing risks that your company is in, right? If we deem that the TP risk is actually healthy, then we have other means to actually rectify the solution. If the TP risks for your company is actually rather significant, then we would then tell you that, okay, this is the impact that you will face if you do not prepare the limited TP documentation and also do a benchmarking to test and to actually substantiate your TP risks involved, right? Then the main point is it's a cost versus benefit, right? It's either you don't do it and you face the consequences, or you do it and then you have penalty protection that will actually save you money in the long run instead of making you in a further loss-making position. So generally speaking, what we do is we go through with the client what's the expectation, and we tell them what's the impact, and then from there we'll decide what's the best case scenario in that circumstances.
Okay, thank you.
Anything
Hong
else,
Chan.
Adriana?
Yeah, I think to add on to
Sorry.
Hong Chan, now the level of comfort you need, it really depends on the circumstances on your risk appetite, right? So what we always think about when we are advising clients on transfer pricing documentation, think of the practical side of it. How much is your risk? If you are looking at a transfer pricing arrangement that is, say, 100 million, the potential risk of an adjustment, even though it's a 2% adjustment, is materially higher than when you only have 100,000 transfer pricing arrangements. So you need to work through, is it cost effective for you to do a comprehensive study on a small value transaction as compared to if you have a large volume of reader drinks passing through your company. So I think that is one of the key things to consider when we are looking at the level of comfort that your company wants. And also, the second thing is, we have done a lot of studies for many different transactions. We have a little bit of idea on what type of pricing is appropriate to certain type of transactions. We can do a risk assessment based on what you are applying, what transfer pricing you're applying internally, and we can sort of tell you, there are guidance provided by tax authorities. There are simplified rules that you can apply that tells you whether or not the pricing is more or less acceptable by the tax office. So this we will take into consideration as well when we are looking at, whether or not you need a comprehensive study, or you can just get away by, a limited study. So yeah.
Okay, so we have 2 more questions, and I think we have 2 more minutes to do it. There is a related party between the holding and a subsidiary company. TPD is prepared by holding company. Is the subsidiary required to do the same, or can it be reference to the holding TPD?
Maybe you want to take that, Adriana?
Yeah, no problem. So I think it is a bit of what we spoke earlier regarding the need to do or to localize the documentation for Malaysian purposes. So I think you can use the holding TP documentation as the basis to do a first cut and be consistent with what you are preparing locally. But the full usage of what we call the benchmarking or economic analysis will really depend on the type of transaction that you are testing. Because essentially, if what you're testing is a contract manufacturer who is based in Malaysia, the chances are that if the holding company TPD does not include a benchmarking for Malaysia, that you will need to then corroborate the analysis from the Malaysian point of view. So if on the flip side, what your holding company is analyzing is an intercompany loan, then you will have to see what was the approach and if the approach is also relevant for the Malaysian tax authority and it follows the same principles.
Yep.
So that's why it is a good starting point, but you need to still double check that is relevant, and especially the economic analysis contains data that is relevant for Malaysia. And there is one last question. Unless someone, we have like 1 minute. Does anyone want to say anything?
Yeah, I think just a very quick overview on the approach for overseas prepared documentation. You have to, there's two things you have to bear in mind, is whether or not the globally or overseas prepared transfer pricing documentation complies with the local transfer pricing rules. Yes, most of the tax jurisdiction overseas which have transfer pricing regulations generally follow the principle suggested in the OECD guidelines, but you will have certain special ruling issued by certain countries that need to be addressed. For example, Singapore have different specific transfer pricing rulings compared to Malaysia. So if you are preparing transfer pricing documentation for Singapore, you might have missed some key requirements of the Malaysian transfer pricing regulations. Now that's the first part. The second part is, don't forget that you need to submit or provide the IRB with the transfer pricing documentation within 14 days. So if you are leaving the transfer pricing documentation with your overseas head office, you might need time to get it from them. They have to go back to their database or their file to search it up for you. So there's a timing consideration there.
Excellent.
Yeah.
So I think with that, we have one more question, but we are very much on time. So before we can answer it live, but before we answer it live, just our contact details. If you need if any of the panelists want to reach us, feel free to write us on our email, visit us on our website where we post a lot of relevant content and articles, and follow us on social media on LinkedIn, Facebook, Twitter, and YouTube. With that, if you guys don't mind staying 1 more minute to answer the last question. How do we qualify the 15 million related party transaction? Does it include loans and advances balances too?
Right. For that 15 million does not include balances. So the 15 million includes revenue expenses that has happened during that particular year, right? On top of that 25 million and 15 million related party transaction threshold, there is another criteria that you need to meet as well. So which is 50 million worth of financial transactions balances, right? That in itself, we are looking at the balance. So if you have financial transactions worth up to 50 million balances, then you need to prepare a transfer pricing documentation, full-fledged TP documentation to actually focus on that intercompany advances. So yep, I think that should answer the question.
There is one last question, which is about what will be our scope of work and fees. So to that person answered, we feel very flattered. Nevertheless, we will be more than happy to speak after the webinar. And you can contact us in any of our emails. As every price, we will have to understand what is the circumstances of the taxpayer. And I think that brings us to the end of our webinar. Thank you very much to all the attendees that took the time to take 1 hour out of your busy agenda to
Thank you.
listen to our updates. Thank you to our panelists today, Honchon Tan and Karen Tai. And please stay tuned, as we will be doing a couple of more new webinars coming May about COVID-19 implications for Malaysia.
Yep.
And we regularly publish these events also in our website for webinars relevant to Malaysia, Singapore, and the Asia Pacific region. And also in June, coming some webinars related to Australian transfer pricing regulations. Thanks everyone, and have a great afternoon.
Thanks, guys.
Thank you. Thanks,
See ya.
everyone.